makers and market movers. This is The Pulse with Francine Lacqua.
Well, good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London with the conversations that matter, and here's what's coming up on today's program. HSBC profit tumbles 80% in the fourth quarter after a $3 billion charge on its holdings in a Chinese bank. We'll have more from our interview with the chief executive, Noel Quinn. Chipmaker NVIDIA faces sky-high expectations when it reports later as traders wait to see if one of the biggest stock rallies in history was actually justified. Plus, the UK delivers the largest budget surplus on record in January, a boost for the UK Chancellor ahead of the spring budget and general election later this year. Now, coming up this hour, our interview with Joyce Chang, the chair of global research at JP Morgan. Also, our exclusive conversation with Bruce Flatt, the chief executive of one of the biggest asset management giants, Brookfield. Now, let's take a look at the European markets map. A lot going on because of the earnings. We're seeing a little bit of fluctuation across the board. If you look at the major stock market or some of the benchmark stock markets, so I'm looking at FTSE, for example, down 0.6%. That's retreating from near the record high. Again, we had some mixed earnings. So if you look at some of the companies that came out today with figures, I'm looking at Glencore dropping after a steep profit slump. I'm also looking at Rio Tinto. This is, of course, the world's biggest iron ore miner. That declined as underlying profit fell on weaker metal prices. But, for example, on the flip side, we have Carrefour gaining after the French company announced a share buyback. We'll also talk about HSBC. It's pretty much flat apart from the FTSE MIB in Italy. That's gaining 0.4%. Also, the French building material company Saint-Gobain says it's in talks to consider an acquisition of its Australian rival, CSR. So it's offered to buy CSR. I think we now just have confirmation from that. It was a Bloomberg scoop earlier for $9 Australian per share in cash. Now, shares in HSBC have plummeted after disappointing earnings. The bank has taken a $3 billion impairment charge relating to its investment in a Chinese bank. Well, earlier we spoke to Chief Executive Noel Quinn, who told me that the charge is a technical accounting issue with no impact on capital.
Well, I'm very pleased with the fact that we've been able to report 30 billion of PBT, which is obviously a record. But also, I'm very pleased with the return on tangible equity. We've been working hard for the past 4 years to make sure we deliver mid-teens returns. And we did that last year. You know, before material notable items, we had a return on tangible equity of 15.6%. I'm also really pleased with the dividends we've announced, 61 cents, which is the highest dividend for the full year since 2008. And we completed $7 billion of buyback. And we announced another $2 billion, up to $2 billion buyback this year. So I'm really pleased with that. Strong capital generation. And I believe with a CET1 ratio of 14.8%, we've got strong potential future capital distribution as well. In the fourth quarter, we did have some noise in the numbers. We had three principal items that pulled down the profit. The first one was we rebooked the loss on sale of our French operation now that we completed that transaction. It's neutral for the year because we took a credit on that in Q1 and we've taken a charge in Q4. So that nets each other out and neutral. There was an adjustment for hyperinflation in Argentina driven by the devaluation that took place. That's really a technical issue. And then the third issue, technical issue, was BOCOM. We have had an investment in BOCOM for 20 years. Every quarter, we have to do a valuation in use test. We did that again this quarter, updated the model. And it compares the value in use to the carrying value. And the value in use dropped below. And that resulted in a $3 billion charge. I just want to make clear that has no impact on our capital position of any significance. It does not prohibit distribution because it's non-capital impactful. It is a technical accounting issue. And I also want to reiterate, we have strong confidence in the China economy. We believe there are huge opportunities ahead. And we believe that our partnership with BOCOM has been a good partnership for 20 years, and that status has not changed.
Well, that was the HSBC chief executive, of course, Noel Quinn. We spoke earlier, and he was really at pains in explaining that, look, this was an accounting concern, that he was quite proud of the earnings. And then we, of course, also spoke about the share buyback. Now, to talk about HSBC and the banking industry as a whole, we're joined by our Bloomberg opinion columnist, Paul Davies. Paul, thank you for joining us. So HSBC is down. We heard there from the chief executive really trying to justify why they had to take their impairment, saying, look, there are challenges ahead for the economy, but the bank is pretty strong. Do you have reservations on or, you know, why is the stock down?
So I think the stock is down, like you were saying, because of this surprise charge on BoCom, and because of the surprise around the effects of Argentina and the devaluation there and the accounting that they have to use for that. I think with BoCom, the interesting thing is that, as he said, it didn't affect capital, and the reason why is because they have a bunch of sort of regulatory, restrictions on capital that are related to their kind of investments in other financial groups, which is quite standard for banks. And when they wrote down this stake, when they impaired the value of BoCom, they were allowed to release some of those restrictions. And what they were just telling investors and analysts on the earnings call before I joined you was there's another sort of $14 billion worth of these kinds of restrictions that can be released against any future write-downs of BoCom or other financial investments that they have. So I guess they're kind of trying to reassure people there that not only is this one, this particular instance doesn't hurt their ability to pay dividends or do buybacks, but they have this other kind of very large set of capital that they could release against any future charges.
Paul, so in my interview with him, and again, he did say that actually, the bank is very well provisioned on some of the China real estate risk. He also said, look, he doesn't expect a big spillover coming, for example, from the commercial real estate in the U.S. There was not much commitment on how much they would return to shareholders for the whole year. I mean, do banks now just need to give back in terms of, dividend share buybacks, like we've seen it with a number of banks, including UniCredit, for investors to buy into the story?
Yeah, I mean, I think, banks are complicated and difficult things to understand, and investors like to see the money to demonstrate that the bank is doing well and performing well. I mean, I think that HSBC is one of those banks that's in a very good position. They've still got this Canada sale to go through. They've committed to probably doing a special dividend when that sale goes through and they get the cash from that. And then the analysts at Citigroup, in their note this morning, were saying that even after that special dividend, they'll probably have another $8 billion of capital in excess of what they need. So they've got plenty of money to carry on fulfilling, further buybacks next year. Beyond that, as interest rate income starts to decline a little bit or not grow as fast, then there'll be more questions about how much returns they can really make then.
Yeah, Paul, thank you so much. I'm looking forward to reading your column. Paul Davies there from Bloomberg Opinion. We touched on HSBC, but of course, Paul also wrote brilliantly on Barclays and some of the challenges there. Now, to talk more about markets, interest rates, and of course, what kind of environment these banks are operating in, we're joined by Maria Municchi, fund manager at M&G Invmt Mgmt. Maria, as always, thank you so much for joining us. I feel like January 2024 is certainly like a tale of two fortunes. If you look at asset classes, they're not really all performing the same way. There's these big days of risks. Like, what will be fundamentally what the market's looking at over the next couple of weeks?
I think it's been very, very interesting to see a start of decorrelation actually across asset classes, so between fixed income and equities in the start of the year, which is something we have not seen for quite a long time. But also when we look within asset classes, within equities, within fixed income, a lot of differentiation of returns if you look at the tech sectors in the US versus Chinese equities, for example. And this is potentially an opportunity for asset allocators to find opportunities in an environment which, to my mind, continue to be pretty unpredictable and very much data dependent. So we have seen low volatility so far in markets this year, but I think there is quite a lot of data coming up that could potentially shift the narratives around what we're seeing. Today, investors are very much focused on not only a soft landing, but very much a no landing. So I believe the growth is quite robust. But I think we have to be conscious about data coming up.
Maria, what's interesting, so I'm subscribed to every single newsletter under the sun and analyst research that I can get my hands on. And this morning it was all like, it's NVIDIA day, it's NVIDIA day. I mean, is this now like almost as important as Jobs Day to try and figure out whether the rally that we've had, certainly for the Magnificent Seven, makes sense?
I think the role of these companies have increased massively when we look at relevance for global markets as a whole, not only for their single performance, but also for some of the sentiments they bring to investors overall, and the willingness to continue to back equities and this growth trend. So absolutely crucial to observe what's going to happen with NVIDIA's results. I think the underpinning fundamentals are very, very strong, especially on a longer-term perspective. The stock has run a lot, but valuations on a longer-term basis might not be so extreme. And I will say also that, yes, there is a very important data point today, but also next month there will be a conference around tech users, and that will continue to feed information to markets to make decisions around those stocks as well.
Maria, and you say it so beautifully, this is it's almost a sentiment gauge, right? If tech does well or some of these valuations are okay, then the rest of the economy will do fine. But actually, it's a very different. I mean, we need to look at inflation. We need to look at productivity in the U.S., which is soaring. So is it a little bit of a misnomer, focusing so much on valuation instead of looking at some of the other fundamental, I guess, questions?
Completely. And I think, you are seeing within one economy like a very different piece of the puzzles, and it's very important to keep an eye on all of them. And I think one area that potentially, has gone recently under the radar is the U.S. regional banks, which were very much in focus in March last year. But, when we look at some of the fundamental trends there has been a reduction in lending standards. Those are tighter today. I think at the beginning of the year we've seen a bit of a normalization, but the consequences that this can have on small and medium businesses, it's also something that I think has to be at the core of what investors are looking at today, but also what the central bank will be looking at when making their next decisions around rates.
Maria, thanks so much. Maria Municchi there from M&G Invmt stays with us. Coming up, our exclusive conversation with the chief executive of asset management giant Brookfield. Bruce Flatt tells me about plans to invest in financial infrastructure and the future of commercial real estate. That's next, and this is Bloomberg. Now, Brookfield Asset Management plans to start a pool that invests in financial infrastructure such as payment systems as demand for the asset class grows. Now, in an exclusive wide-ranging interview, the chief executive of Brookfield, Bruce Flatt, also told me that he believes there are opportunities in commercial real estate. Well, Brookfield is one of the world's largest infrastructure investors.
We own the backbone of the global economy. So we're trying to find good countries, go there and stay there, invest in these things, and whether governments come or go, or interest rates go up a little bit or down a little bit, aren't really relevant to these themes in the long term. You need to make sure you have liquidity, you can fund yourself, and you run good businesses, and that's more important than those general trends. So we're investing for 10, 20, 30, 40, 50 years, and you can't get too caught up in the day-to-day effects.
You've also gone to credit. How much are you expecting that to grow?
Look, what's happened with regulations in the banking system is they've just, it's pushed out credit off the balance sheets of the banks, and the right place where that is being funded from is institutional investors. And therefore, investors like ourselves are continuing to grow our businesses where we're funding these type of products, but it's not our business is not in competition with the banks. It's actually in partnership with the banks, and as a result of that, I'd say it's facilitating the growth of the global financial markets, as opposed to something that often people talk about that we're at the wrong time in the cycle or whatever it is. This is going to be growing and happening for a long period of time.
So how big do you expect?
It's going to get big. Because remember, this is where most of the capital is in the world, is in sovereign institutional funds, these and pensions. These funds used to be 20 and 30 billion. Today they're 300 billion, 500 billion, $1 trillion, $1.5 trillion. These are large sums of money. They need to put it to work, and therefore it's going to continue to grow for a long period of time. We have in our private equity business, we have a buyout sponsor business. But we're also doing, we're just in the midst of creating a strategy for the Middle East, which will be a separate pool of money. We're creating a strategy for financial infrastructure because we think that's the next phase of infrastructure investing is in the financial backbone of the global economy. And a lot of the world has been pushing towards financial infrastructure, and it's not appropriate for our infrastructure fund.
Right.
But so we're creating a new pool of money to do that. And so there's a fine line between having too many things and making sure your clients who want to be invested with you in that type of area have a pool to be able to do it with us.
Commercial real estate. So a lot of people say, look, this is not the right time. We're going to see a shakeout in commercial real estate. There are opportunities that you see.
Yeah, I think, look, the next story is that interest rates are coming down. Fundamentals are pretty good in a lot of commercial real estate. Of course, there's a tail of some investors that had properties that for this environment, the fundamentals either don't support it or the financing they have can't be supported, and therefore those have to get dealt with. So that's a tail that's getting dealt with within the financial system. But fundamentals are actually getting better. Interest rates are coming down, which means the values are going to improve. And but that tail, there's opportunity coming. And if you know what you're doing, you can pick the right assets. There's a great opportunity here, and
so you're buying.
We are buying. Our opportunistic fund. We just bought some. We foreclosed on some loans for multifamily in the U.S. recently. We're very excited about that, and we continue to look at a bunch of things. Do
you see anything in Europe?
Absolutely. I think there'll be. The biggest, most liquid markets are in the United States. That doesn't mean, therefore, because they're the most liquid, you always find the most opportunities. But Europe, there's less capital, and therefore there will be opportunities here as well.
But how do you make a difference between the ones that will get better and the ones that actually you should forget?
I would just say it depends on the types of real estate. You just need to quality wins always. It always has. It always will, and therefore, if the great money can be made in buying high-quality properties that have financing problems. That's where the easy money is made, and that's the biggest focus of ours.
Well, that was Bruce Flatt, the Chief Executive of Brookfield, speaking exclusively to us, and then you can catch him on Leaders with Lacqua coming up next month. Coming up, we listen back to Andrew Bailey's latest comments, sending a message on the BOE's rate cut prospects. That's next, and this is Bloomberg.
Inflation to come back to target before we cut interest rates. I must be very clear on that. That's not necessary. So we'll be looking for sustained progress on those things to reach that judgment about how long this period of restrictive policy needs to be. But we have very clearly signalled this change.
Well, that was Bank of England Governor Andrew Bailey on the UK rate cut debate. We're back with Municchi from M&G Invmt Mgmt. It's not easy being Andrew Bailey right now because he has a tougher job than everyone else. Are you invested in UK equities?
I think the UK at large, equities and bonds have seen quite a tough reaction from investor sentiment, and this provides potential for good returns in the future should things normalize. I think in particular in UK gilts, after the recent rally in yields, we're starting to see some more opportunities again. We can see inflation starting to come down and even better than expected. And at the same time, the economy is potentially weaker than in other parts of the world, in particularly relative to the US. So I think the current level of yield is potentially attractive over a longer period of time. Obviously, there might be still some volatility along the way.
I'll say the elections, the budget.
Absolutely, yes. I think there is very much a lot to look forward within the US, and I think whatever the outcome of the election will be, I think we might see some, volatility within the market before that could provide opportunities. But also, I would say the next government will inherit quite a difficult situation from an economic standpoint. So there will be quite a lot to see in the UK. Going forward, I think.
Maria, do you worry about commercial real estate and impact or infecting, other parts of basically our markets?
I think it's an area that was very much in focus a few months back last year, and then it's going to be under the radar. I think it remains quite important to keep a keen eye on that. I think the change in interest rate will definitely have an effect on some of the weaker part of that market. But overall, it could also present some opportunity over the longer term because some of the business are equipped to withstand higher interest rates. I think, alongside other long duration assets, like, for example, renewable energy infrastructure, we have seen quite a lot of weakness last year. But when these businesses are well positioned and have good quality, they could actually present today some very interesting longer term opportunities. But we have to observe what the shifts will be. So, for example, from a banking perspective, maybe providing different type of lending at more tighter standards, and then maybe different players coming in to fill these opportunities.
Maria, thank you so much, as always, for joining us today. Maria Municchi, their fund manager at M&G Invmt Mgmt. Coming up, our interview with Joyce Chang, the chair of global research at JPM. This is Bloomberg. HSBC profit tumbles 80% in the fourth quarter after a $3 billion charge on its holdings in a Chinese bank. Chipmaker Nvidia faces sky-high expectations when it reports later, as traders wait to see if one of the biggest stock rallies in history was actually justified. Plus, the UK delivers the largest budget surplus on record in January, a boost for the UK Chancellor ahead of the spring budget and general election later this year. Well, good morning, everyone. Welcome to the Pulse. Good afternoon if you're watching from Asia. I'm Francine Lacqua here in London. So from the AI boom to the rising geopolitical tensions across the globe and a record-breaking year for elections, JPM has pinpointed its key strategic investment themes for the year ahead. Well, joining us now over the next 15 minutes is Joyce Chang, Chair of Global Research at JPM. Joyce, it's so good to speak to you, especially when we're trying to understand the markets that, frankly, are not always easy to understand. Are these markets priced to perfection?
Well, I mean, it has been a record-breaking year for capital market activity to start the year. I mean, in credit markets, we saw an all-time record high, $361 billion of issuance in the month of January in the credit markets and the leveraged loan markets, record highs. Now, I think you stay fully invested here, but I'm not surprised that you're going to see, a little bit of a pullback here. And you have seen that the inflation numbers, surprised on the upside, which is sort of what we've been pointing to as well. But that was in the U.S. and Europe as well.
Why do you think these valuations are stretched? So was there an inner belief that started at the end of last year that actually, central banks will act quite fast to cut rates, and so everything was priced in too quickly?
Well, I think there's the soft landing scenario, which we agree with for 2024, but 2025 could be a different story. But when we take a look at the central banks across the globe, I mean, we have by the end of the year, 80% of them are going to be easing. So that is a synchronized cycle. So I think the combination of recession off the table for this year, also the synchronized easing in emerging markets and developed market central bank. But your surprises have been, did too much get priced too quickly? And that's what we're seeing when we look at the inflation prints. And I think the market's going to turn away from looking at some of the earnings to focusing more on the inflation topic over the next few sessions.
So how are you expecting inflation to behave? A lot of the markets, of course, are pricing in cuts. That's now been delayed. But there's no clear view in my mind on whether inflation, on whether it's the last mile that's difficult to get to 2% inflation, or whether it's just going to be choppy.
I think that the 2% inflation target is not going to be met. The disinflation trend, though, I mean, what you're seeing is some stalling, but it's the services piece of it that's non-cyclical. That still the demand for services, for transportation, for sports, entertainment, wage pressures are still there. So I mean, we actually took up our inflation forecast at 3.3% for the first half of the year. We had had it at 3%. We always thought that the easing cycle would not start until June. So I think still by mid-year, though, you're going to have most of the developed market central banks easing, even with inflation still being above target. So I think it's bumpy from here, but everything got priced very quickly.
But this is because they worry about the labor market, or they worry that if they don't cut, the economy crashes?
Well, I think that there was a feeling that, particularly with the Fed, that they had done so many hikes that there's the room with the disinflation we've seen to do more of the cuts. I think it's actually trickier in Europe and for the UK, given where wage pressures are at. But labor markets remain very tight. So the market has, had been pricing in March cuts. That's been moved out. And the question is, will you see that there's some space to cut rates, but as you get towards the U.S. elections, that it's not nearly as much as what the market had been expecting at the beginning of the year?
Joyce, when do you start looking in your research about what a Trump presidency means for domestic U.S.? At the moment, one of the things that I find most surprising is actually productivity in the U.S. going through the roof. And I can't figure out whether that's tech and AI or whether it's just finally things are kicking in.
So I don't think it's tech and AI. I think it's too early to say that. I think the surprise that we all got wrong was that immigration is back to pre-pandemic levels. And this is why the labor market has been so tight. So I think the labor productivity is very much related to immigration. And of course, if it is a Trump presidency, that whole question, comes up again. But the key policy things we're being asked about Trump right now relate to tariffs and whether this could mean the continuation of stronger U.S. dollars, and what this means for actually other foreign currencies, including the euro, CNY, Mex peso in particular.
And we've seen it also with the Biden administration. They've been pretty tough, actually, on China. So is dollar going to strengthen no matter what?
I think the dollar will remain strong. I don't know if it's going to necessarily strengthen further from here, but we've done some scenarios that if you take a look at a proposal for a 10% universal tariff, we think that is 4 to 5% appreciation of the dollar. So that does, have consequences. It's a growth penalty for the rest of the world and a stronger dollar.
There's so many questions about debt, and I know there was a lot of focus 2 weeks ago on some of the auctions. Do you worry about a credit event actually going wrong in the U.S.?
I don't really think that it's a credit event that will go wrong. I mean, there is hidden leverage that's building up, but it's building up in the private markets. So you're not going to see the type of forced deleveraging that we've seen before. And we've seen that the market conditions for both investment grade and for high yield coming to market, and the private market dry powder has given a lot of cushion here.
But the private market, I mean, there was worry about commercial real estate and, the spillovers, for example, in Europe and especially in the UK.
Yes.
Is this a concern? Do we know where the bad stuff is? Or
well, I don't think it's a systemic concern.
Fine.
It is certainly a concern in certain pockets.
Yeah.
But for something that is systemic, I don't see that. And what we've actually seen is this increase in commercial bank lending that has come up as well. So I don't think it's a credit that will do this, but the credit market is priced for perfection. I mean, this is one where, just the pickup is very, very small, for what you're actually getting on historic basis. So I think it doesn't have the best value right now, but I don't see the accident really playing out there.
There's so much focus on NVIDIA. Does that really give you a bellwether on whether the current market valuations are okay? Are we expecting too much of one company?
Well, I mean, look, the bar is very high to beat what the expectations are because they're sky high. So I think the numbers are going to look good. You could still see the market go down, though, just given how much has already been priced in. But I don't see really stepping away from staying fully invested, particularly with the soft landing and the Fed easing still to come.
Do you move money around to, for example, Europe or the UK, where valuations have been pretty ropey?
Well, I mean, look, we still think that your risk in Europe and the UK are higher than the U.S. when you look at growth downside surprises and where consumer sentiment is at, and that you still have this precautionary savings. You haven't gotten the consumer sentiment back. So I think the U.S. is still to be preferred. I mean, another one I would throw in is that even though it's a 33-year high, Japan equities, we think over the longer term, even with the fourth quarter contracting, those numbers contracting, still holds promise over the medium term.
I mean, a number of challenges, I would say, for the governor in the next couple of months in what he does with this monetary policy.
Yes.
Will he get it right, or is it like if he gets it right, everything's fine? If he gets it wrong, then you get out of Japan?
I think that they're going to be very patient on how they exit. But more beyond just the exit, what I do see is that really animal spirits are apparent in Japan right now with respect to the asset reflation, the property prices, also just personal income trends. So I think they will be patient there. So I don't think it's about any one meeting, but they're not in a rush right now. And the fourth quarter growth numbers were a disappointment.
Joyce, what's your take on the UK? Again, the central bank probably has one of the hardest jobs because it's a tight labor market, it's a small, open economy.
Well, of all of our global forecasts, the one economy that we do have in recession second half of the year is the UK. So I do think it is a tough place. But we still have that you will see, some room to ease around the middle of the year. But I think the wage pressures are much higher. The housing affordability situation, mortgages are still a problem here, even as we're seeing a turnaround in some other parts of the world. So I think it is a very complicated situation here. But there's still some scope to ease. It's whether they're going to have to actually bring it forward a bit more, just given where the growth dynamics are at.
But so what you're saying is basically if they don't cut sooner, then they definitely go in recession, or do you predict a recession almost no matter what the Bank of England does?
We sort of had in our baseline, a modest recession, and other places where you might be skirting it. But in the UK, that it looked more apparent. But I think the timing for what they do is very much dependent on how you see some of these labor market pressures playing out. We still see some scope to ease, but is it going to be more backloaded, or will they bring it forward just depending on how the growth numbers look?
Any value in gilts?
I still would say the U.S. exceptionalism, the dollar story, still is one that is dominant amongst the developed market currencies here. So, so we think that on the currencies that particularly as you get towards Super Tuesday, you get the nominations in place, and it looks clear that it's Biden-Trump, which is already pretty clear in my mind anyway, that you still have that stronger dollar trend really prevail here.
So interesting. Joyce, thank you so much. Don't go anywhere because we'll talk about China and Europe next. Joyce Chang, Chair of Global Research at JPM, of course, stays with us, and this is Bloomberg. The conversations that matter, the insights you need. This is The Pulse, and I'm Francine Lacqua here in London. Now, still with us, Joyce Chang, Chair of Global Research at JPM. Joyce, we're talking, thank you so much for sticking around. We're talking a little bit about some of the markets and, of course, the fact that you don't see a recession, certainly in the U.S., is a key risk to 2024. We touched on politics. Is it, when you look at interest rate cuts from central banks around the world, there was a belief maybe 6-7 weeks ago that the Fed would go first. It looks now that the ECB would go first. Does that change market dynamics?
Well, we never were in the camp that thought that the Fed would move in March. We thought that the market was getting way ahead of itself. Now I think you're actually looking at mid-year where it is going to be somewhat synchronized between the ECB, the Fed, and the Bank of England. Will they actually have to sort of move up their timing as well? So I think you are looking at synchronized cuts, which is one reason why there's so much reluctancy to cut holdings in this market when you can see that the easing is coming forth. But I still think what stands out is that the U.S. growth story is still one that looks to be in a much better place than the Europe or the U.K. And the questions that we have been getting on Europe have really been about, like, with the wage increases that have happened, why haven't we seen more of a recovery in consumption? Why is it still only a 0.5% growth that we're looking at in the EU this year, last year?
And how difficult is that to explain, actually? Why?
I think there's the proximity of the wars, that are just, much closer in. You also have elections on the parliament side where it seems like the center right is going to pick up. But I don't know how much of it is just, there are questions about the longer term model for Europe, the dependency on Russian gas, and, there's more trade with China that has actually increased, and just questions more about the model and the uncertainty from the geopolitical risks that are just playing out more here, whereas the U.S. seems to be one where it's more about U.S. exceptionalism. There's more of a story on innovation as well that you can talk about.
Joyce, how would you play Europe? I mean, Germany is a huge concern for, of course, the Chancellor, but also the rest of Europe, because they have huge economic concerns.
Well, I'm talking to our strategists. A lot of them have been actually recommending Greece right now. I mean, within Europe, they think that France is actually looking more promising right now. But still a lot of questions about the overall outlook for European growth, which still remains very anemic and tepid at best.
China. I have a lot of questions on China, which is probably the economy that's most difficult to read. Has Chinese real estate bottomed out?
I think that China still has a problem with the property sector as its Achilles heel. It does look to be a double dip this year, even with the measures that they're taking. And the problem is both a supply and a demand problem. So I think that the steps that the government is taking right now have provided some form of stabilization, but it hasn't provided the confidence boost. And so I actually see a lot of similarities when I look at Europe and China, that you just haven't been able to get the domestic private market and that confidence to come back very easily.
And Joyce, it hasn't also, the markets were expecting something a lot more from policymakers. So I don't know whether it changes the longer-term trajectory for world growth.
Well, look, if you take a look, we have to talk about the debt, because the U.S. and China have actually been growing their debt at the most rapid pace. But if you take a look at China, just last year alone, you had more than a 12 percentage point increase in their debt. So they can't do much more on the fiscal side. And some would look at the U.S. and say, well, look, that's the most predictable crisis you can see coming forward at some point in time. So I think you have to put the debt dynamics into this as well. So even if you avoid the inflation, you may not see that you get much relief on the rate side. That's really what's playing out right now.
I think that there was a belief that also the Chinese economy was significantly changing and going up the value chain. And it was my understanding that they need to go up the value chain by around 30% to actually, make the economy work. Is that happening?
Well, there are certain sectors that are doing very well, like the dominance on the electric vehicle side and some of the advanced technology. But if you look at the overall investment in China, you still have not seen that private investment has come back. And we are seeing movement of the supply chain. It used to be when we did some of these surveys, businesses would say, 10 or 15% of them were moving some part of the supply chain. Now that number's coming out 25 to 35%. So even though you see certain sectors where China is doing well, the overall numbers that are printing for private investment have been really disappointing. And foreign investment, the first outflows in 26 years.
So given that, how do you play China?
Well, right now, valuations are looking more compelling if you're a dedicated emerging markets investor. But I still think the story for a crossover investor to come into China, they haven't seen the reason to find that very compelling yet. So, dedicated investors have basically said, well, you look at valuations and you're taking more of a medium-term view, there are opportunities there. And I agree that on valuations, there's a tactical play. But what we are seeing is just this 10-year trend of getting real money to come into China as a crossover investor. That's what's not going to come back very easily at all, in my opinion.
Joyce, you travel the world and speak to investors and speak to your clients. How many questions do you get about why markets are ignoring geopolitics? There's 2 wars, active wars. There's concern over Taiwan. The world feels so much less safe than it did 4 years ago.
Well, I think the first question that I end up getting when I'm overseas is about the U.S. elections. And then questions about the geopolitics from there, like what will happen as far as funding for Ukraine. If it is a Trump victory, what will happen in the Middle East? Will this become more of a regional conflict? But I think in the Middle East, the feeling is that, at least it's not going to hurt the oil exports that much. And you have all of this capacity that's in place right now on the energy side. I think there's also a view that on the commodity markets, like if you have the Fed starting to ease, that's going to be good for commodities. Look at the soft landing in 1995, you had commodities up about 20%. And I think that there's this feeling that you have these conflicts in place that are not going to be resolved, but they won't necessarily escalate more from here. But all eyes are on the U.S. elections.
Joyce, I usually ask, is there any chance that actually world economies can Trump-proof their economies? And I usually get eye rolls, certainly from leaders. But are we moving into that direction?
Well, I think you are moving into more regional trade agreements. a rise in industrial policy, which you can see in many parts of the developed markets and the emerging markets. So I don't know if it is so much just like putting in guardrails, but it definitely is looking at greater self-sufficiency and more flexible cooperation. That that you see with emerging markets countries, they don't want to have to choose. They want to be able to be flexible in how they choose their alliances.
Joyce, thank you. Smart and sophisticated thinking is what we always get from Joyce Chang, our the chair of global research at JP Morgan. Now, coming up, markets on tenterhooks ahead of NVIDIA earnings that will confirm whether sky-high valuations are justified or not. We'll have more on that story for you next, and this is Bloomberg. The conversations that matter, the insights you need. This is The Pulse. I'm Francine Lacqua here in London. Now, NVIDIA is in focus as a chip maker at the heart of the AI boom reports earnings later today. Now, shares sank more than 4% yesterday in the run-up. So let's get more from Bloomberg's Alex Webb. Alex, thank you for joining us. I mean, it's really quite incredible, the expectations for NVIDIA. So is it almost a given that investors will be disappointed, or can they actually deliver?
Well, on one level, expectations are exceptionally high, right? The guidance was for revenue of 20 billion plus or minus 2%. The market's expecting 20.4 billion, which is literally 20 billion plus 2%. So anything below that is likely to be disappointing, but they have a track record of consistently beating expectations. But if you look at it through the valuation at which they're trading, they're in the sort of 35 times forward earnings multiple. That isn't actually way outside the realms of normality, right? It's actually maybe 5th or 6th in the SOX index, the Philadelphia Semiconductor Index. AMD, sort of smaller competitor in the AI space, is trading at a way higher multiple. It's partly, of course, because it isn't yet getting those earnings from AI that NVIDIA is. So, and of course, Microsoft, now the biggest company in the world, trades at about 33, 34 times earnings. So it's in that ballpark.
So you're telling me it's cheap?
Well, I'm not saying it's cheap, but it isn't way up in the stratosphere in that particular sense. Of course, it's gone from being a $700 billion company to a $1.8 trillion company in just over a year. So, it's clearly enjoyed a huge expansion, but its revenue has also more than doubled in the space of a year. So, yes, expectations are high. We've seen some options trading, which is anticipating a move of as much as, I think, 11% in either direction, which is perhaps why you saw a bit of profit taking yesterday. That clearly is because, if it beats, then there's a big leap. And if it misses ever so slightly, then, of course, it's not going to be good news.
But if you look forward, so how long can this pace of revenue growth actually last? I mean, do you look at blueprints, or is this just a different company from anything else we've seen?
Honestly, I don't know. We can see what the analysts are expecting. Analysts are basically expecting it to continue much at the same pace, going to, from 59 billion in revenue for fiscal year, what they call fiscal year 2024. It actually ends at the end of January 2024, going to 96 billion, sort of in this calendar year. Analysts clearly think it's going to keep going. The biggest issue for them right now is actually not necessarily demand, it's supply. Can they get enough capacity at, for instance, TSMC to make the stuff? We are starting to see some competitors gain a little bit of pace. Of course, AMD, we mentioned. Some of their customers, the likes of Microsoft, are building and developing their own chipsets in-house that might take little chunks out of them. But for the near term, it certainly looks as though there's plenty of demand for NVIDIA.
But Alex, how strange is it that actually the whole NASDAQ is almost on, if not borrowed time, but, if NVIDIA goes well and that share price goes up, then it kind of drags everything with it?
Yeah, I mean...
Is that a fair assessment?
It is in a sense. I think I wrote a newsletter for the tech team over the last earnings cycle where I said, actually, if you think about this Magnificent Seven, and a few wobbles from some of them, and it's bad news for the market as a whole. But actually, this time, we have seen a few wobbles. We saw a little wobble at Microsoft, a little wobble at Google. The others seem to have done OK. Is NVIDIA then the straw that breaks the camel's back? Maybe, who knows? But NVIDIA's particular importance, perhaps because of the mixed picture at the others, right? I think that's the level in which we have significance.
So interesting. Alex, thank you so much. We'll all be watching those NVIDIA earnings. Alex Webb there with the very latest. Let's also recap one of the top stories this morning. Shares in HSBC have plummeted after disappointing earnings. The bank has taken a $3 billion impairment charge relating to its investment in a Chinese bank. You can see HSBC down 7.5%. We'll have a full roundup of the top news. Of course, we're looking at NVIDIA. Up next, Bloomberg Brief with Danny Berger in London, Manus Cran. Actually, Danny and Manus, I think, are both in New York. This is Bloomberg.